Total income hit a record high, but core lending profits silently bled out by 5% year-on-year. If you are relying on these dividends for your retirement, this shift from stable interest to volatile trading fees directly impacts your portfolio's predictability. Here is the forensic audit of overseas Chinese Banking Corporation's latest results, exposing the gap between the glossy headlines and the actual balance sheet mechanics. I have been watching this one for a while, and the number that finally made me sit up was the structural margin squeeze. This is one of those pieces where I had to run the data twice because I simply did not believe it the first time. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. The headlines point to a record income, but what they skip over is the silent bleed happening underneath. Stable interest income is being rapidly replaced by volatile trading fees. We need to look past the surface and perform a forensic audit of what the headlines are ignoring. Here is the framework. The industry filter for banking structures mandates that we lead with two bedrock metrics, the NIM and the CET1 ratio. NIM is the spread between what the bank earns on loans and what it pays on deposits. It is the absolute core engine of a traditional lending bank. The CET1 ratio is the capital fortress ratio, measuring the bank's core equity against its risk-weighted assets. These two metrics form the absolute foundation of a bank's ability to generate cash and protect itself from systemic collapse. Looking closer at the raw margin data reveals the pressure. The net interest margin data makes the pressure impossible to ignore. The margin compressed to 1.76%, down from 2.04% in the first quarter of 2025. This drove a 5% year-on-year decline in net interest income, down to 2,222 million Singapore dollars from 2,345 million the prior period. That is not a rounding error. The lending margin is under intense structural pressure. If the 3-month Singapore overnight rate average benchmark drops by another 10%, net interest income will contract even further. This brings us to a very relatable dynamic on the ground. Think of this margin squeeze exactly like the gross profit margin of a hawker stall. It is the difference between what the hawker earns from selling a plate of chicken rice and what he pays for the raw ingredients. When the cost of chicken goes up and he cannot raise the plate price, the margin disappears. Overseas Chinese Banking Corporation faces the same structural squeeze. Loan rates are falling, but deposit costs simply cannot be cut fast enough to compensate. Yet the capital fortress tells a very different story. The bank reported an exceptionally strong CET1 ratio of 15.2%. This represents 347 billion Singapore dollars in customer loans backed by solid reserves, meaning it can absorb massive defaults without needing emergency capital. Your principal is protected, but capital safety is not the same as income reliability. What rescued the quarter is exactly what you see driving the growth: non-interest income. It rose 23% year-on-year to hit an all-time high of 1,606 million Singapore dollars. Wealth management fees were the primary engine, surging 14% to 1,483 million Singapore dollars across both banking and insurance platforms. This dynamic pushed headline net profit up 5% year-on-year to 1,974 million Singapore dollars. For the heartland investor holding these shares for yield, this specific segment is what paid your current dividend. Without this 23% surge, overall net profit would have collapsed. Let us check how the liquid reserves hold up under these conditions. The liquidity position remains a sound fortress. The LCR, the proportion of high-quality liquid assets the bank holds to survive a 30-day stress scenario, stands at 138%, improved from 132%. The NSFR, measuring stable long-term funding, rests at 113%, marginally down from 114%. Both only require 100%. The bank holds more than enough liquid reserves to survive a severe stress event, but the way they are using these reserves gives us a major clue about the future. Here is my first insight on this. The single metric management spent the least time discussing was the exact composition of the 216 million Singapore dollars in allowances. They quietly labeled these as driven by heightened macro uncertainties. They are using a stellar wealth management quarter to quietly build a massive war chest for a rainy day without alarming the market. When banks start stuffing cash under the mattress while simultaneously celebrating record top-line income, retail investors must pay absolute attention. Overseas Chinese Banking Corporation is proactively preparing for a global economic storm that they are not talking about publicly. Management is far more cautious than their press release suggests. That caution requires us to look very closely at the current valuation. Here is my first insight on this. The single metric management spent the least time discussing was the exact composition of the 216 million Singapore dollars in allowances. They quietly label these as driven by heightened macro uncertainties. They are using a stellar wealth management quarter to quietly build a massive war chest for a rainy day without alarming the market. When banks start stuffing cash under the mattress while simultaneously celebrating record top-line income, retail investors must pay absolute attention. Overseas Chinese Banking Corporation is proactively preparing for a global economic storm that they are not talking about publicly. Management is far more cautious than their press release suggests. That caution requires us to look very closely at the current valuation. We must now contrast that narrative with a harsh reality check. Investing Pro places the fair value at 17 Singapore dollars and 37 cents. The current market price is 21 Singapore dollars and 96 cents. That represents a massive 26.4% premium to assessed fair value. The market is aggressively pricing this as a high-growth wealth manager, but the forensic balance sheet tells us it remains a traditional lending bank facing severe structural margin compression. This gap between price and value forces us to re-evaluate the product we are actually buying. You are looking at a commodity product wrapped in premium packaging. The bank's cost-to-income ratio is maintained at a highly disciplined 39.3%, which shows genuine operational efficiency. But price is what you pay on the exchange. Think of it like buying a fair price item with premium packaging. The marketing tells you it is top tier, but the ingredients list says otherwise. You are paying a 26.4% markup for a commodity product at a growth multiple. At current prices, the numbers do not support the valuation. Let us lay out the scorecard. For this audit, I apply a conservative stress test floor of 3.2%. I am auditing for the storm, not just the sunny day. While the treasury bill might temporarily sit at 1.40%, I do not lower my forensic standards to match a temporary market dip. My floor remains firmly at 3.2%. Adding 150 basis points gives us a minimum yield hurdle of 4.7%. This is the absolute minimum required to ensure sanctuary assets can withstand a return to long-term average interest rates. Let us apply this to the income metrics. The income scorecard shows exactly where the bank failed and where it succeeded. Net interest income failed, dropping 5% year-on-year from 2,345 million to 2,222 million Singapore dollars. They failed to grow the core interest business. Non-interest income, however, was a clear pass, surging 23% to 1,606 million Singapore dollars. This successfully engineered a significant beat that pushed net profit to a passing grade of 1,974 million Singapore dollars, up 5%. Now let us turn to the safety metrics protecting that income. The safety scorecard is a clean sweep of passes. The CET1 ratio of 15.2% easily clears the 9.0% threshold. The non-performing loan ratio is exceptional at 0.9%, well below the 1.5% danger line. The LCR and NSFR both sit comfortably above their 100% requirements, fortress-level safety metrics across the board. Capital ratios are providing immense downside protection, but we need to look at how this impacts what ends up in your pocket. Looking at the dividend trajectory, we see the shift in composition. For fiscal year 2024, the regular DPU was 86 cents. In fiscal year 2025, the total payout jumped to 98 cents, an increase of 14% year-on-year. However, the regular component actually dropped to 82 cents, with a special dividend of 16 cents making up the difference. The ongoing fiscal year 2026 payouts show 42 cents regular and 16 cents special so far. This shift in composition requires a serious warning for anyone banking on these payouts for daily expenses. Here is the yield compression warning you cannot ignore. Special dividends are purely discretionary and non-recurring. Retirement income planning must be anchored to the regular DPU trajectory only. That fiscal year 2025 regular DPU of 82 cents represents a slight pullback from the previous year, while the share price appreciated an aggressive 42.4% over the same period. This is a price story, not a dividend cut story. But for new buyers stepping in today, the forensic consequence is completely identical. The yield is shrinking. Let us look ahead to see if the underlying capital remains secure. The forward outlook confirms that your capital is indeed safe. The non-performing loan ratio has been frozen at 0.9% for 8 straight quarters. This places the bank at the absolute pinnacle of conservative underwriting in the region. They have 163% provision coverage already in place to absorb any Greater China real estate defaults, covering 3,120 million Singapore dollars in non-performing asset volume. Your capital is shielded by an impenetrable wall of reserves. The income story, however, carries a completely different risk profile, which leads us to the 3 possible scenarios. Three forward scenarios are playing out here. In the bear case, if the Singapore interbank rate drops below 1.0%, the lending margin compresses below 1.6%, putting the regular dividend at severe risk. The base case assumes rates hold at current levels, with wealth management successfully offsetting the lending decline, resulting in stable distributions. The bull case requires non-interest income to break 1,800 million Singapore dollars, which could allow for continued special dividends. Much of this depends on the people steering the ship. Management credibility is high. They simply do not overpromise. Last year, they guided for stable asset quality despite massive headwinds in the regional property sector, and they delivered exactly that, with the non-performing loan ratio frozen at 0.9% for 8 consecutive quarters. Management has genuinely earned forensic credibility on capital preservation. But the open question remains, can wealth management fees, which are highly market sensitive, sustainably carry the dividend burden that core lending once did? This leads to my second core insight from the audit. My second insight dives right into the footnotes. The forensic verdict on management credibility is positive. They executed the exact wealth management pivot they promised to offset the lending margin collapse. However, the heavy reliance on Great Eastern Holdings and trading income introduces mark-to-market volatility that core lending income never did. They have earned our trust on capital preservation, but do not mistake accounting flexibility for operational immunity. The discretionary provision buffer they are quietly building suggests they already know the next chapter of this story is harder than the headline profit figure implies. Forensic investors read the footnotes because management always signals in the footnotes. Let us talk about why reading these signals early is crucial. The red flags were always there, waving clearly in the balance sheet long before the market reacted. The crash was never a surprise. In this market, the difference between finding a true sanctuary and falling into a yield trap is decided before the opening bell, not after the damage is done. The warning signs are written in the margins, the cost ratios, and the non-recurring income streams. The question is whether you have the forensic framework to read those flags in time. It is time to change how you approach these critical numbers. It is time to stop being the exit liquidity for institutional money. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access. You get the complete red zone watch list, the gearing ratios, the occupancy gaps, and the debt overhangs audited before the market even opens. For just 9 Singapore dollars a month, which is less than a kopi and kaya toast at Raffles Place, you stop being the exit liquidity and start being the analyst. The link is in the description. The forensic synthesis places this stock squarely in Zone 4, which signals caution. The current distribution yield of 4.52% sits 18 basis points below my 4.7% minimum hurdle. However, this is a price problem, not a structural dividend failure. If the stock retraces toward the investing pro fair value of 17 Singapore dollars and 37 cents, the yield will re-rate above the hurdle and the zone trajectory will improve materially. Zone 4 reflects the current price reality, not permanent income impairment. Let us look at the hard gates and soft flags that confirm this. The hard gate assessment confirms the failure. The yield of 4.52% misses the 4.7% hard gate by 18 basis points, triggering an automatic Zone 4 minimum. The capital adequacy ratio of 15.2% and non-performing loan ratio of 0.9% both pass. 3 soft flags confirm the assignment. Margin compression across 2 consecutive periods from 2.04% to 1.76%. Earnings quality concerns as dividends are carried by volatile non-interest income and trading at a 26.4% premium to fair value. Let us map the trajectory. The zone trajectory is clearly mapped. Zone 4 is confirmed by the hard gate failure alone, and the 3 soft flags firmly reinforce that assignment. The catalysts for a potential upgrade are a price retrace closer to fair value, or a sustained margin recovery if the rate environment stabilizes. The next major review trigger will be the second quarter of 2026 earnings. Until then, the caution label remains firmly attached. For those unfamiliar with the system, here is how the zones break down. Zone 1 represents a fortress yield above 5.5% with minimal gearing, perfect for retirement. Zone 2 is the watch list demanding close monitoring. Zone 3 is conditional, it might survive one more cycle. Zone 4, where this bank currently sits, means caution, suitable for speculative plays only. Zone 5 is the red zone, a full stop. Zone 1 and Zone 2 stocks are assessed separately for CPF and SRS suitability. Under the Iggy classification system, the portfolio role here is purely opportunistic. This belongs on a watch list. Accumulation suitability is conditional, only making sense if the price retraces towards 17 Singapore dollars and 37 cents. Transition suitability is also conditional. The capital safety is fortress grade, but income reliability is not present at the current market price. Drawdown suitability signals caution. The dividend is increasingly carried by non-recurring, market-sensitive income rather than steady lending. This brings us to the two separate questions every investor must ask. We must separate capital from income. The bank answers the first forensic question convincingly. With a capital adequacy ratio of 15.2% and a non-performing loan ratio of 0.9%, it is absolutely a capital sanctuary. Your principal is exceptionally well protected. But is it an income sanctuary? At 21 Singapore dollars and 96 cents, income reliability is conditional and not confirmed. The price is too high for the yield being generated by volatile trading operations. Which brings us to the ultimate question for your portfolio. Is your retirement income resilient enough to depend on the unpredictable whims of trading fees and wealth management commissions when the stable interest income eventually runs dry? This bank is a brilliant preserver of capital, but paying a 26.4% premium for a shrinking core lending engine is a fast track to dividend disappointment. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access link in the description. The window is already open. For those relying on this yield to fund their daily expenses, the time to adjust your expectations is right now. Before the next rate cut forces your hand, check the description to secure your access to the full 7-day embargo window. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MACI licensed financial advisor before committing funds.